For much of modern corporate history, bold, irreversible bets were seen as a sign of confidence. Companies committed massive capital to long-term projects, entered new markets decisively, acquired competitors outright, and reorganized around fixed strategic visions. Once those decisions were made, turning back was costly and often impossible. In 2026, that behavior is becoming far less common. Across the U.S. economy, fewer companies are making irreversible bets, and this shift reflects a structural change in how risk is understood and managed. The most important reason irreversible bets are declining is persistent uncertainty. In earlier eras, businesses believed that uncertainty would eventually resolve. Economic cycles turned, regulations stabilized, and demand patterns became predictable again. Today, volatility does not fade. Interest rates, technology platforms, regulation, geopolitics, and consumer behavior all shift continuously. When the future refuses to settle, locking into permanent decisions becomes dangerous. Irreversible bets amplify downside risk. If assumptions hold, the payoff can be large. If they break, the damage is severe and long-lasting. In 2026, executives and boards are far less willing to accept that asymmetry. They prefer strategies that allow correction. Optionality has become more valuable than conviction. Capital discipline reinforces this behavior. Capital is more expensive and more closely scrutinized than it was during years of easy money. Large, one-way investments now carry a higher opportunity cost. Companies want to preserve flexibility so capital can be redeployed if conditions change. Reversible decisions allow capital to stay liquid longer, which protects balance sheets and strategic freedom. Technology has made reversibility more feasible. Cloud infrastructure, modular software, contract manufacturing, and flexible supply chains allow companies to scale up or down without committing permanently. Instead of building fixed assets, firms rent capacity. Instead of locking into single vendors, they design portability. This reduces the need for irreversible bets and lowers the penalty for being wrong. Organizational learning also plays a role. Many companies carry scars from irreversible decisions made in the past decade. Overexpansion, aggressive acquisitions, permanent cost structures, and rigid product bets created long-term drag when conditions shifted. These experiences reshaped leadership instincts. Avoiding irreversible mistakes has become a strategic priority. Regulatory uncertainty further discourages permanent commitments. Rules governing data, labor, trade, and technology evolve quickly and unevenly. A strategy that depends on regulatory stability can become unviable overnight. Reversible bets allow companies to pause, adjust, or exit without dismantling the entire organization. Investor expectations have changed as well. Markets now reward resilience and predictability more than ambitious long-term projections. Sudden write-downs or abandoned mega-projects damage credibility. Investors prefer companies that limit downside exposure, even if that means slower expansion. This shifts incentives away from irreversible bets. Workforce dynamics also influence this trend. Hiring large numbers of employees for speculative growth creates long-term obligations that are difficult to unwind. Companies now favor flexible staffing models and incremental hiring. This reduces the human cost of strategic missteps and lowers internal resistance to change. Irreversible bets also clash with modern execution realities. Complex organizations struggle to execute massive, all-or-nothing initiatives cleanly. Dependencies multiply. Coordination costs rise. Failure becomes harder to contain. Smaller reversible bets reduce execution risk by limiting blast radius when things go wrong. Importantly, avoiding irreversible bets does not mean companies have stopped acting. They are still investing, expanding, and innovating. What has changed is sequencing. Decisions are staged. Commitments are conditional. Progress is measured in checkpoints rather than endpoints. Companies move forward while preserving the ability to retreat. Some critics argue this approach signals caution or lack of ambition. In practice, it enables action under uncertainty. Leaders move sooner because they know they are not trapped. Fear decreases when exits exist. Reversibility often accelerates initial movement rather than slowing it. There is also a governance effect. Boards increasingly ask how easily a decision can be reversed if assumptions change. Reversibility has become a formal evaluation criterion alongside return potential. Projects that cannot be unwound face higher scrutiny. Why fewer U.S. companies are making irreversible bets ultimately comes down to realism. The business environment no longer rewards permanent certainty. It rewards adaptability, resilience, and controlled risk-taking. In 2026, the strongest companies are not those making the boldest one-way moves. They are the ones designing strategies that survive being wrong. They accept that not every bet will succeed and build systems that can absorb that reality. Irreversible bets once defined leadership courage. Today, strategic flexibility defines leadership maturity. Companies that preserve optionality can respond to change rather than be crushed by it. The decline of irreversible bets is not a retreat from ambition. It is an evolution in how ambition is executed. In a world where change is constant and assumptions expire quickly, the ability to adjust has become more valuable than the confidence to commit forever. And that is why irreversible bets are quietly disappearing from U.S. corporate strategy.